ambition can almost be a trader's worst enemy.
You can definitely add more pressure to yourself, right? If you go, right, okay, I need to make 500 quid a week.
Most ventures that are valuable require you to do some kind of qualification or some kind of test beforehand, but trading doesn't. We used to have a coach here that helped us out with some training. He said, right, here's your badge, here's your gun.
Right, this is a long-term thing, and your trading plan then is really wait for it to go up. But you also need to act, and I think that's a problem that a lot of people face when they start trading, is that they are almost too hesitant to get into the market.
If you're honest with yourself, most people break those types of rules.
Like the emotions that are running in between, like for me when I'm trading on the live compared to the demo. When I'm in the demo, ice in my veins, I hold the position.
Position sizing also comes into this. Position sizing is so key.
Is that the market will always humble you at some point and give you a slap no matter who you are.
I want to open a trading account. What does success look like? Welcome to another episode of Talking Shop with IG. And this is a new one for us. We're simultaneously going out live on Trade Live with IG, and it's going to be recorded for a podcast. So, a merging of the worlds. And I'm joined by my glamorous assistants, Pete Ward.
Hello.
And Ronni. Ronni Agling is back.
Back again. Another substitution.
Back once again with the Renegade Master, right?
Exactly.
Pete, you're back. You weren't with us a couple of weeks ago. Where were you?
That was late shift, I think it was. I was seeing a client. That was it.
Oh yeah.
One of those.
It's clients first, you know that.
Clients first.
Champion them.
That's it.
We've got to champion the clients.
But yeah, Ronni did a great job, so I've come back to fight for my seat.
I've got to keep my spot. Sean's out.
Sean's out. Sean's on the late shift today. We've got to keep this. We're keeping this rolling, right? So we're keeping a rolling crowd.
Yeah.
Of people that are going out, carving their careers on Trade Live with IG, and then you move into the fast lane. Then you come into Talking Shop, and we're going to be here each week.
Exactly. This is the A team.
This is the A team. So, what are we talking about this week? This week, it's all about the trading plan. We're continuing our Tradecraft series. We're here to not tell you, what markets are the most interesting or what setups to use and all this kind of stuff. What we're here to do is to say, how do we act with intent? So when you are trading, how can we give you the tools to help we succeed? And this week, it's all about trading with a plan, trading with purpose. So I'll kick us off just with a quick definition. We actually used these guys last week, but the Corporate Finance Institute defines a trading plan as a systematic approach used to identify and trade securities based on several variables, such as investment objectives, risks, and time. A trading plan lays out your procedures and conditions for which to search for asset classes and execute trades. And kind of with that bubble, we know trading is, and having a plan is more than just trading with a hunch, right? You can't look at something if you haven't done some form of research. And so what I want to just kind of use to introduce this discussion is what are some of the essential elements that you see in a trading plan? What does a trading plan mean to you both?
Yeah, for me personally, it's like you said, not trading on a hunch, having a systematic approach to it. So always try to define my entries and my exits before I actually go into it, and make sure that I know what I'm trading. So I'm not like a dog chasing its own tail, running after the next trend and see what's ever moving. So being systematic and having the criteria that I select when I trade.
Yeah, interesting. I think I've tried a number of different things, I think, over the years in terms of a trading plan, whether that's like a numeric target, and whether it's a percentage amount. But I think what you try to refine, I guess, over time is a clear, like you say, clear entry and discipline, basically. Trying to put that discipline in place where you don't repeat certain mistakes of the past. Main one being don't average in. That's the kind of one that I try to keep at the forefront of my mind. I think there's a great slogan. One of my clients told me about this. He said that he used to work for Paul Tudor Jones.
Oh yeah.
And he said that in his office he had a big slogan above his desk, which is "Losers average losers." And he was like, if you remember that, you won't go far wrong. And to be fair, it's kind of correct. So I think having that in my plan is definitely part of it. And then a clear level at which you go, right, okay, it's done what I wanted it to do. I'm never going to get at the top, I'm never going to get at the bottom. Let's take something out of the journey and then exit.
Yeah, I think for me, it's about being intentional. I've had runs in the past where I know that I'm punting. And that's fine, I think, if you live in that kind of sporting world and you want to use this as a way to express just a view. But I think as you become more of an accomplished trader, you need to sit there and you need to have intent. And so I haven't yet found success in terms of making a specific target, because I worry that if you don't hit it, it then gives you more problems down the road when you're starting to chase a specific goal, like a specific financial amount or a specific number of points. Ambition can almost be trader's worst enemy.
Yeah. You can definitely add more pressure to yourself, right? If you go, right, okay, I need to make 500 quid a week, and let's say you're at 300 or whatever, but there's no setup and it's Friday afternoon, chances are you go in, you're probably going to lose that 300.
Yeah, that's when you're taking those unnecessary risks that you don't want to.
Yeah. But if you've got that pressure on yourself to say, well, I need to finish the week and close the laptop and say that I've banked the 500, you're going to go back in. So I think a trading plan is helpful in those sorts of scenarios, as long as you're not too married to a financial amount. I think, we've touched on it before in this series of kind of risk management, and we're talking about loss prevention, and we're talking about the capital protection, as opposed to trying to make money. We're trying to not lose money, right?
Exactly. That's the most important thing.
So I think that's important.
Yeah. For me, I think trading is one of those slightly weird ventures. If you needed to be qualified to go and do something in any other walk of life, you've got to sit a test, right? Driving test. For us, you walk in the front door, we're going to ask you to go through a series. We're doing it with some of the guys that have just joined the team now.
Yeah.
We're going to simulate a bunch of client phone calls with clients. If you wanted to go on the Trade Live with IG show, we're going to do some dry runs with you before. Yeah. Most ventures that are valuable require you to do some kind of qualification or some kind of test beforehand, but trading doesn't, right? You open the account. We used to have a coach here that helped us out with some training. He said, right, here's your badge, here's your gun, you're the sheriff now, right? Yeah. And it doesn't really work like that when you're going to go and blindly take a leverage position in something you don't really know about.
Yeah, that's when you end up paying your tuitions to the markets.
Yeah, that's it. Yeah, it could be an expensive private school. Right?
Yeah, very much so.
But I mean, I think, and that's the key differential in what we do here, I guess, with the leverage side of the business, on the spread betting and the CFDs, is people can come to trading, and if they come to it in the form of share dealing or ISA share dealing or whatever that might be, you might have the view that you go, right, okay, well, I want to buy this stock, and if it doesn't go too well, I'm going to own it until it does go well, right? So then you can get, right, this is a long-term thing. And your trading plan then is really wait for it to go up.
Yeah.
Whereas if you're trading on leverage on an intraday, intra-week basis, you can't have that mindset. You've got to go, right, I'm going in because of this reason. And if it goes wrong, I'm coming out here. And if it goes right, then I'm either going to go with it or I'm going to come out at a certain point.
Yeah.
You've got to actively manage it. And I think that's the key differential.
I think so. I think that's the key difference for me in terms of trading and investing. Trading is, I've got an idea, I'm going to put it on. I've got very clear criteria about when this trade is coming off. And for me, it's not a time thing. It's if this stop is triggered or if my target gets met for whatever reason, that's basically forming the best part of my plan. What I haven't added, just because we are in this new fancy world of live, if you do have any questions, we are streaming this on the platform in real time, also on YouTube. So we're piggybacking on the Trade Live with IG Tech. If there's any questions, we're going to try and catch them at the end. So we're aiming to be on until about 10:30. So if you've got any questions at all to put to the guys, pop them in the chat and let us know. To move into the kind of nuts and bolts of this question then, I've seen people get bogged down in analysis paralysis, where there's just too many things to read. If a new client comes up to me and says, what's a strategy? There's countless. So what would you say as some advice to someone who's trying to find that sweet spot between research and actually pulling the trigger? So what do you need as a fundamental? What are the couple of things that you need fundamentally to be ready in order to then be confident to take a trade?
Yeah. So one thing that I often do is sort of, like you said, there's a difference between investing and trading. So when you're trading, you have to keep in mind that you're trading on a shorter sort of horizon. So I like to follow the news to see what's actually going to happen. Based on that, what I read, what's happened, I make a decision. Right, this has happened. This is what I think will happen. And then after that, once I have that sort of criteria, I then go on the chart, see where it's trading, and then from there, fine, okay, we ended here, I think, because of X, Y, and Z that happened yesterday. I think we're going to end up here. If we don't, if I'm wrong, I have my exit level here, because I'd rather minimize my loss than, let it run and come back around. Because if you let it run forever, you're just going to end up losing your account to overnight funding.
Humans are the lowest edge in this game, I think, because of emotion. Because of emotion, because of ambition. So you've got to be rules-based. You've got to be either fundamental based, and then you've got to look at things like, okay, is this a mean reverting strategy, or is this a breakout strategy, or is this a buy the dip type of long-term investment?
Yeah.
It isn't, unfortunately, Lambos and get rich quick TikToks. No. It's definitely not the case.
Yeah, you've got to do some degree of work, right? But you also need to act. And I think that's a problem that a lot of people face when they start trading, is that they are almost too hesitant to get into the market. And they want to stick around, maybe watching what could have happened, paper trading, demo trading, all that sort of stuff, which I think is important for a little bit, as long as you set yourself a time where you go, right, okay, now it's time to actually put something into the market. Because if you don't act, you don't get the actual live feeling of trading and having that risk on. It's like, you play poker for no money on a demo account, you're going to go in on every single hand, right?
Yeah.
Whereas if you're trading and you've got actual, it doesn't need to be a lot, but actual skin in the game, all of a sudden you're live and it's real. So I used to work with a guy, and he used to say, it was quite a good kind of analogy, if a little bit salesy, but he used to say, like, if you want to be a Formula One race car driver, you can't sit on a PS5 all day long playing. You've got to get in the car, right? You've got to feel it. You've got to feel that. And it's the same with the trading. So I think you've got to do your research, have a read around what you want to do, maybe stick to, when you're starting out, just 1 or 2 markets. Don't try and, do 20 different things and cross correlations and trading yen against commodities and all this sort of stuff. Just stick to a couple of different things, maybe 2, maybe 3 markets. Get to know the price action on those markets. Get to know the natural prices, where things should be. And then when you're ready with this trade setup, just give it a go in small with a stop.
Yeah, I think our trade of the week product that we've got that Axel runs is if you don't want to use it as a way to trade, that's fine. But I think using it as a tool to understand the thought process behind someone who's managed money, behind someone who is incredibly technically focused, Axel will use a 1% of his account stop every time. That's it. That is the rule, and he'll have no more than 3% of his account at risk at any one time. That in itself, just those restrictive guidelines, if you're honest with yourself, most people break those types of rules.
Yeah, and that is a trading plan, isn't it?
That is exactly a trading plan. Yeah. And you can run the numbers, and there's plenty of assets on our website where you can look at, they've run, they did Axel with his trading coach did a simulation of 100 trades, 20,000 times. So we ran this kind of Monte Carlo simulation again and again and again. And he was looking at trying to test different risk versus reward levels. I think we mentioned it in the maths episode, but I was talking to a client about it yesterday. On a 50% hit rate strategy, which I would say is still quite good, there is a 100% chance that you're going to lose 5 trades in a row at some point.
100% chance.
Yeah, there's over 20,000 simulations.
Yeah, so
there's a 100% chance on a coin flip.
Yeah,
50-50, you're going to lose 5 in a row. Now, if you're risking 20% of your account, that's your account gone.
Yeah.
If you're risking 1% of your account every single time, that's 5% of your account gone. It's impossible, therefore, if you're trying to keep this to 3% max risk cap, you can't lose more than 3% because you're going to get stopped out by your system. That in itself is you can be fundamentally based. You can say, right, I'm buying BT because of the double downgrade. I want to buy the dip. You could be looking at, BP because you want to follow Elliott management into the trade. But if it drops down 1%, you're out, and that's it. And you let the system drive it for you.
Yeah, 100%. That's sort of an important factor that, like we said, you have your predetermined stop levels, but also for me, myself, I know that I've traded both demo and I've traded on the live. And, I get some shtick for trading on the demo. But when I compare the two, like the emotions that are running in between, like for me, when I'm trading on the live compared to the demo, when I'm on the demo, ice in my veins, I hold the positions, whatever.
Well, because it doesn't matter, right?
Exactly, it doesn't matter, just monopoly money. But when it's my real hard-earned money, I know how many client calls I've answered to make this money and trade it. I'm way more careful with it. And, like you said, looking at Axel, you don't have to be a pro. You don't have to spend 30 years doing whatever Axel did, but taking advantage from someone who has and following that, or adopting it and doing it your own sense. I think that's a really good one when you can take from others and sort of implement your own criteria and rules. That's where you can build up your own strategy and not following someone blindly, but taking inspiration from them.
Yeah.
What do you know? One of the things we're looking at a bit more at the moment, and I know you've been looking at it with the Tasty product, is trying to use mathematical expectations to set your stops and your limits.
Mm-hmm.
So one of the things I've been talking to a few of my guys about is Tasty. You can look at time periods, so you can look at the weekly and the monthly series of options. And granted, this is going to be US stocks, it's going to be US traded futures, but you'll get most of the macro indices over there and FX trades. Using the option construct, it will give you an expectation of what the price move could be in that time period.
Right.
That then, the odds of the market trading at that level. Now, of course, fundamentals can change, right? The C can change, the volatility can change, CPI could come out and the world, drops 5-6% overnight.
Yeah.
But using mathematical expectations and probabilities to start setting your stops, we're starting to get a bit more advanced here, but that feels like a way where, instead of just putting stops on a whim, feels a bit of an easier way for people to start to translate, to say, well, that's where the market is currently pricing it could or couldn't go. Think about it.
Yeah. I mean, you can use those. You could dive into, like you say, on Tasty, you can look at percentage of getting there, or look at the delta of something and see the likelihood of that actually occurring, and then place your stops. Or you could just go basic support resistance.
Yeah.
Where are the stress points in the market? Where should I typically be? If you're going to trade, an index, then look at what the daily range is on that index, and then plan accordingly.
That's what I hear.
There's no point trading the FTSE with a 5-point stop. Like you're going to get knocked out, even if it goes right in your direction. It's going to gyrate a little bit because that's what it does, right? So I think looking at it in terms of, where has been the recent high, where has been the recent low, where is the sort of the support, where is the resistance, and then just putting your stops kind of just around those levels, really.
Yeah, but how many times have you heard the market makers are out to get me?
Yeah.
Or they are the big boys, all this kind of stuff. Support and resistance, I've always struggled with support and resistance just on a basic level, because the chart is the chart, right? Every person looking at that market is looking at exactly the same level that you're looking at.
Mm-hmm.
And they're going to say, okay, there's going to be a high here. I'm going to put my stop a couple of ticks above the high.
Yeah.
And then that goes. Or you're going to say, put it a couple of ticks below the low. And it will always happen that the market reverses, because it's just, we're so biased and we're so kind of stuck in this loss aversion type of mentality that as soon as you put a stop loss, you go, right, I'm stopped out. Oh, and the market reverses in my face, right? That's just the most frustrating thing.
I mean, it's sort of like, but the clients getting stopped out, or you getting stopped out. I had one session with Axel and a client, and the client said, I never put stop losses. I did it once and I just got stopped out right away. Well, then Axel said that, well, yeah, if you put the stop loss just underneath or too close, of course you're going to get stopped out. There's nothing wrong with having a stop loss a bit further away. Just allow yourself with some breathing room, and everything's not going to go exactly continue with the chart. That's just not how it works. So give yourself some breathing room and allow yourself to take those swings, but have a bottom, like a floor.
Yeah, I think I can see we've got some questions on stops. So we'll come back to some more of these specific ones at the end. And this is going to form part of our Tradecraft series. I think we're going to do a whole episode on stops. I think it just having a whole episode on closing conditions, I think, is really, really important.
Mm-hmm.
But to kind of continue the conversation just around plans, what's your take on a trading journal?
So yeah, I mean, I've heard about and I've seen a trading journal. Personally, I think it's a good idea. I just don't know if it's realistic. If you're trading actively, i.e., maybe 10, 20 times a day, are you going to journal and document all of those trades? But then I was, we were talking about this the other day. I was saying, if you were trading pretty much exclusively trading your own money as your job almost, you could build it into your daily structure. So if you're on the screen, from UK Open until after, I don't know, US Open, and then you do the UK close, you could put in 40 minutes at the end of the day to say, right, let's go through what I've done and what's worked and what hasn't. And I think it'd be a valuable thing to do. It's just whether or not it's realistic.
How many people do you reckon that are trading 20 times a day are genuinely doing it profitably?
I think it's very few people.
Small, right?
Don't know.
Yeah.
I'd like to see the
Because then
numbers.
if you're going to be that active, it helps keep the lights on at all your brokerage accounts. Fantastic, thank you very much. But you're paying a lot of spread away,
Mhm.
so that's going to eat into your profits every single time. And it's
True.
not. It's you start to think about, are we playing this game in the most efficient way? Well, probably not. If
True,
you were to
true.
swing a position, we have
But
a guy
then,
that
you
calls us.
speak to day traders and they go, well, I'm not paying anything overnight then because I'm done. And I shut the laptop for the day. And you go, yeah, I get that. I do hear that.
Yeah, but effectively, if you're trading 20 times a day, you're effectively scalping, right? Like some sort
More
of
than
scalping.
likely, yeah, scalping index.
Yeah, you're effectively scalping. And then you're just taking these tiny, tiny wins, which is great until you get a massive loss and all of your 1 month of profits are eaten up.
But then if you've not got discipline.
If you've not got discipline, right? And position sizing also comes into this. Position sizing is so key. If you're risking 1% of your account, and this we will go into in another episode, because in fact it's going to be next week. I've already planned it, so sneak peek. Position sizing next week. But if you set a stop distance first, okay, because you've got to take the view that if you're going to drive the car, you're going to go out with insurance, okay? Because otherwise, the unthinkable could happen.
Mm-hmm.
You put a stop that's 10 points away and you're trying to risk 1% of your account. Your position size is then driven by 10 points divided by 1% of your account. That's where you get your position size from.
Yeah.
And of course, if you then continue to think about this in an optimal way, if you make 5 losses, you've lost 5% of your account, well, your account is now worth 95%. So your optimal position sizing now needs to be lower.
Yeah.
So that the idea is you're constantly capital preserving each time. And it works both ways as well. So the idea is that you dial up your size when you're growing. Otherwise, you're never going to make exponential returns. You're never going to make this a fruitful discussion. So look, what are the nuts and bolts of a trading plan? Being rules-based or being technical or being discretionary, that's all okay. Be very specific about how you manage risk. I would say be very specific about your entry and exit criteria. Risk management, so using stops, optimal position sizing, knowing where your risk reward is. These things are all super, super key. And a trading journal, look, if you're trading once or twice a day, I think it works. I think you don't have to write, War and Peace, but you just need to be honest with yourself and say, I've entered because of this reason. I've left because of this reason. My setup that I'm choosing is I've seen 3 green candles and I'm below the RSI and I'm breaking above a MAC, whatever it is. You then, I genuinely think if you were to document 100 trades and you were just testing different things, right? And you're jumping between strategies or you're jumping between setups, do it in tiny size. You've then got a database that you can then query your own trades and say, well, actually, trading gold at 3 in the mornings, that's out straight away because I've tested that hypothesis and that doesn't work, gone. And you've then got that database to refer back to.
Yeah.
Well, it comes with experience.
What columns would you have in your trading plan then if you were going to journal it?
For me, entry, reason, why, so my setup, opening level, closing level, reason for closing. And then the one thing I'm not good at is having some form of confidence level in it. Because you can go in and you say, right, I'm really confident on this trade, ranked, and Axel does it really, really well. He ranks his emotions and he ranks his confidence levels. So is he tired, right? And he got so granular because he's traded for 30 years that he knows that if he's tired or if he's had an argument at home or that the kids have kept him up all night or that he's got a difficult meeting to deal with at work, those things create low edge environments for him. But you don't know that until you've back tested it in theory by having a bit of a note on what you're doing.
Yeah, I think the most important thing is it's all great taking notes and having 100 columns, but the most important thing is that you actually look back, read them, and then take that into consideration and don't hit yourself with the most dangerous word in the world, the most dangerous words in the world of finance, which is this time it will be different. So yeah, follow your actual rules and take learning from that.
Boring though, right?
Yeah, but then they always say you've got to kind of make trading a little bit boring, right? I know that everyone wants to sort of rock and roll. Let's hit a home run on every trade.
Yeah.
But realistically, you've got to make it a system that works for you more than X amount of the time, and that makes you money over the course of a year or a month or whatever it is that you want to try and do it at. But having, as soon as you engage with risk reward ratios, stop and a limit, and a percentage of your account as your size, that is pretty much a trading plan straight away there. And if you stick with that, it will make it a little bit more boring, but it'll probably make it a bit more, you give more longevity to it.
I have a historic example of what happens when you don't follow, or what happens when you follow your trading rules and when you don't follow them. So, are you guys familiar with the historic trader Jesse Livermore?
Yeah.
The Confessions of a Stock Operator.
Yeah. So he made over 100 million by shorting the stock market because he had his clear-cut rules that he always followed. However, success went to his head, and as Bill Gates says, success is a lousy teacher. So success went to his head. He ignored his own trading rules and over-leveraged and took on more risk than he actually should have done, and he lost everything.
Well, in the words of the great Mike Tyson, right? Everyone's got a plan till they get punched in the face.
Yeah.
And then all of a sudden you're playing defense.
Yeah, and stay humble, stay humble, eh? Like, just because you are on a great run doesn't mean you'll continue forever, and don't stray away from what brought you success.
Yeah. Well, that's one of the best things to learn, isn't it? Is that the market will always humble you at some point and give you a slap no matter who you are.
Yeah.
So yeah, the minute you get cocky, the minute you get, right, okay, this is really working for me, I'm going to triple up my size, or
Yeah.
I've had three great weeks, I can afford to YOLO it all into my final week, will invariably give it back.
Yeah.
As soon as you break that model. So discipline, like we've said from the start, is the key. And I think you can't sit here and say things like, right, never average down, because people will average down, right?
Yeah.
So then you go, right, well, how do you frame that so that you can do it, but do it within a bit more of a confined space? You can say, right, okay, well, I want my overall position size to be X, and I'm going to clip in
1/10.
and I'm going to clip in, and I'm going to do 10 clips if it goes to this bit. But then I know that that's the limited size of my position.
Yeah.
Okay. And then you've got a more realistic area where you go, okay, yeah, no, I liked it there, and I still like it, but it's a bit cheaper, so I'll have a little bit more. But I'm not going to do the same size as my max size 10 times and end up catching a piano, basically.
Yeah.
So I think that's important. We sit here and we're talking about trading, and you've got to be realistic that the book says this, but realistically, humans will do something slightly different. They will flex that, right?
Yeah.
And I think that's fine as long as you keep your notional size under wraps and under control.
Well, think about it.
You do get blown up, especially on leverage. You can do that, like you say, you can do the scalping side of things. You can do the swing trading. But as soon as you get too big, you can get caught out.
Well, let's think about it, right? What to kind of move the conversation on then. So we've spoken about what a plan is and how it can be very simply defined, and then how you can kind of start to think about that. The other side of this is, what do you define success as, right? If you're sitting there as an ambitious new trader and you're trying to say, right, I want to open a trading account, what does success look like? We have a question about setting goals, and should we aim for an amount per week, per month?
Yeah.
What's your take?
In my opinion, if you don't lose money, you're doing brilliantly. I mean, it's like Warren Buffett said, first rule of investing is don't lose money. Second rule is never forget rule number one. I think just not losing money is a great start for a new trader, a new beginner coming in. As long as your account doesn't shrink, I think you're doing something well, because historically we look, majority of people lose money. So establishing a plan that allows you to maybe grow it a tiny bit or whatever is fine, but just try not to lose money and you'll be golden.
Yeah, I like to kind of, rather than setting a numeric target, I think it's good to keep an account size. And so if you're, happy playing with a 20 grand account, and let's say you have a particularly good week and it takes up to 24, take the 4 away and start the next week with the same size.
Yeah.
Instead of trying to go, right, okay, well, now I've got 20% more, I'm now going to do bigger trades. And then all of a sudden you do 5 wrong trades in a row, you're down to 10 grand and you busted half your account.
Yeah.
So yeah, that sort of idea of keeping the book size the same if you can, and just try and farm off some money.
Yeah, makes sense. For me, it's trading's part of a portfolio. So I keep my passive kind of market-based investing in my ISA, in my pension. So I'm long the market naturally through some ETFs, through some investment trusts, and some individual stocks. Right, that's that. Trading is a game to see if I can make some money, and the market's going to reward you or it's not. So I actually think setting an amount of money on it's quite dangerous, because if you say you want to make 200 quid a day, right, and you would we know that you can break the statistics down. Even on a 1% risk, you can lose 3 trades in a row pretty quickly. So you've lost 3% of your account, right? If you've defined the size as such that that isn't a material amount of capital to your overall wealth, you're not going to go on that psychological tilt. But what you are going to do is you're victim to your own ambition.
Yeah.
Because you're now saying, well, I said to myself, I'm going to make 200 quid. My plan says I'm going to make 200 quid. Now you're chasing. So even with the best laid plans, if you start to then think about a fixed amount of money, I think you can really fall into it. For me, it's about the process. If I can sit there and say, this week I've traded with 1% risk, I've genuinely optimized my position sizing. If I've lost money, I've lost money. It's just the market, right? You can make money on a 30% hit rate strategy. You can make money on a 20% hit rate strategy if you manage risk properly. But if I've followed my rules and I've not been rewarded for that, so be it.
Yeah.
My question is, how strict should one be with the rules? Like, should you never stray away? How allow some flexibility, or should you always stick to your rules? In your opinion?
For me, I still think the human is the weakest part of any trading strategy.
Yeah.
I think we can lean into the maths. Trading is about maths at the end of the day. It's about, percentages. It's about managing an amount of risk. If you change that, not saying you have to change everything, but let's say you've got a setup that you're looking at on the FTSE. Okay? That doesn't mean it's going to automatically apply to the DAX or the euro dollar, right? You're going to have different tools for different fights. So what you're saying is, when do you choose to say, actually, my plan's crap?
Yeah.
This is not a good plan. And maybe that comes after, I don't know, if you've lost 10 in a row and you've now lost 10% of your account, you've got to size down.
Yeah.
Maybe you start to draw some fail safes into it. I use the comparison to a banker or kind of what everyone would define as like a professional trader, someone sat on a prop floor. The reason why these guys are typically more successful than retail traders is because they've got a risk manager on their shoulder. They've got compliance. They've got a flow dealing desk that says how much risk they're allowed to take.
Yeah.
Quite often if you lose 10 trades, 5 trades in a row, you're done for the day. See ya.
Yeah.
Go home.
Yeah. Sort of take back, relax. So I guess the room for flexibility is sort of flexibility in changing the plan and not just pushing out the edges of what you're allowed to do within the plan. Because, as we know, just having a plan, that's a great start, but it needs to be a good plan that works as well. So at a certain point, you have to sort of reconsider, okay, what am I doing wrong here?
Completely. What do you reckon, just before we move on to the next section about how we stick to it, what do you reckon the textbooks, I had a quick look through kind of the internet last night. Perplexity was my boy. Just got it all to do it for me. What do you reckon the most widely accepted kind of wisdom is on how long it takes to become a professional, to become a profitable trader, excuse me?
What, in terms of time?
Yeah.
Does it feed into the 10,000 hours mantra?
That's what I was thinking.
That's generally the benchmark.
But they reckon about a year.
About a year.
About a year.
Yeah. I think you've got to experience a significant loss to get that not knee jerk, but that sort of kick in the behind to basically take it seriously and look at it and go, okay, right, that was too big, or that was too cavalier, or I wasn't looking on the screens, or I was doing something when I wasn't going to be monitoring it. I didn't have any risk management in the process. I had a way bigger my trade was way too big for my size of my account. And then from that point on, you then go, right, this is something I really need to pay attention to. And I think, yeah, you're probably right. A year, probably longer.
Yeah, I think so.
Yeah,
I think
100%.
so.
Especially if you want to learn all the different tools. There's trading with a stop, trading with guaranteed stops, there's using limits, there's averaging into a position, trading on stop, buying with the trend higher up prices, I want to get into this, I want to be long. If you did on the FTSE from Christmas, for example, 8100, you go, right, okay, I want to be long this. You could go, right, well, I'll put my initial piece in, and then you go, right, well, if it breaks through 8280, then I think it's going to keep shooting. So you put an order to buy even more on stop. And then, again, and you can look at the technical and go, this all clicks in. It's great. Yeah, I'm paying higher prices than what I could be paying here, but I'm going with the trend.
Yeah.
And that's one way that people, learn how to do it. And then obviously we've got all the option stuff.
Yeah.
Do you all of a sudden start putting covered strategies together? I think, it take years, I would say, to get to the point where you go, right, I know all of the different tools that I've got in my arsenal, and I know how to use them and when to deploy them. And if you can do all of that, then I think you can say you got it as a professional.
Yeah, I mean, Donald, you've mentioned there on the chat, building into positions completely agree with you, right? What we're talking about here is using position sizing as your plan. So if you're going to average into a position, be super strict to say, I'm not going to average down, losers average losers. But if you've got a target position size in mind, maybe build into that across an average period. If the market then moves in your favor, your optimum goal should be, I need to get that stop to break even as quickly as possible.
Yeah.
And if I then average up, I've still got to be super strict on my overall portfolio risk rules, because I know that I'm now adding risk into my portfolio. I've got to be super strict with that. But we're all human. And I think the point on all of this isn't, you're not working for a bank.
No, it's personal trading, isn't it?
Personal trading is to be personal to you. You know, you can't control if the kids are going to have complete fit overnight, and all of a sudden you can't keep an eye on things. So that's why you've got to be super on top of stops and limits. More so for retail traders than anybody else. I want to move on just to talk about like the most common pitfalls. So of course, not having a plan.
Yeah.
Super low edge.
No plan, no exit strategy.
Yeah.
And no real handle on your notional size, or just a complete miscommunication between what you think you're doing and what you're actually doing. You know, what size am I actually swinging in the market? You know, you might think, oh, okay, well, I did 10 quid of FTSE, so therefore I'll do 10 quid of Dow. Well, you know, as we know, the FTSE's a 4-figure number, Wall Street's a 5-figure number. All of a sudden, you've got huge different notional sizes. So a 1% move in one is very different to a 1% move in the other. So it's getting that, just that your mind around, right, what size am I actually controlling in the market? If I've got a 100 grand ticket and there's a 5% move, I know that I could make or lose 5 grand, and I'm okay with that.
Yeah.
I can go to sleep, and you know, I'm going to sleep well. I'm not going to be up all night checking my phone and all this sort of stuff. But if you've got a 100 grand position in, and you know, you're not ready to take a 5% or 10% move, you're only thinking of the upside, you're not thinking of the downside.
Yeah.
You're going to be stressed out, you're going to be chasing your tail, you're going to be over trading.
You get taxed on your ambition at that point.
Yeah.
If you've not controlled it.
Yeah.
If you've not set that stop. I had a conversation with a guy yesterday. He's been a prop trader for years. November, had a great month at the start of the month, got ahead of himself, gave it all back. Started the account in December, did even better, but ended December even worse than when he started. And the whole conversation was about, you know, what have I done wrong? And it was about position sizing, ultimately. But we've done some studies on the most common mistakes that our clients make. Number one is over leveraging, right? Over leveraging, risking far too much. What you said, Paul. Pete, sorry. Not having an edge, not being able to sit there and say this particular mathematical structure that I'm putting in place actually pays me over time. And you can use backtesting, you can use different systems to have a look at that. Not using a stop loss, the third most common. Hopefully, the more you listen to us, the more you watch Trade Live with IG, hopefully this gets drummed in that stops are actually a good thing. They're there to protect you. And averaging into losers. You know, losers average losers is so key.
Yeah.
Who was it that said that?
Paul Tudor Jones.
Paul Tudor Jones.
It's that's the thing about stops is something that I've taken on more recently in my personal trading now as well, is the fact that you've got Axel, who's a 30-year expert who lives and dies by the stops. Don't move the stop, put the stop on, let the stop do what it's meant to do.
Yeah.
You know, if it goes, okay, well, it's not the end of the world. It's actually could have saved me another 100, 200 points. And if I still really love it, you can always have a look at it down there.
Well, no, if you necessarily love it, that's dangerous. If it sets up again.
Yeah.
If your entry conditions are met and you have another look at it.
And then you still want to go, then yeah, you've saved yourself that gap.
Yeah.
And I think that's important. And a lot of clients that we speak to, obviously, you know, we're dealing with sort of premium end of the funnel. These typically high funded, high net worth individuals who might be, you know, running their own companies and be, you know, chief execs of this and be the master of what they do. But when it comes to the conversations about their account, they can sometimes come to it with that mindset of, well, you know, I don't need to stop because I'll just buy more. I'm like, well, yeah, you probably can, but do you actually really want to be doing that? Or would you rather have a more measured position where you go, right, okay, yeah, I'm in the trade because of these reasons, and I've got to stop on. And it's trying to have that conversation of going, you know, stops aren't just something that a new trader needs to use. They're something that you need to use in all of your trades.
Yeah, effectively moving your stop loss is effectively as bad as not having a stop loss at all. I mean, you move it once and then you continue to move it. Oh no, it's gonna turn. I don't want it to hit before it bounces back. I'm gonna look like a schmuck then. No, you look like a schmuck when you move your stop loss and it just continues to go down even further.
Yeah, the one thing I'd recommend, and this is something that as we learn the new Tasty tool that it gives, what Tasty will allow you to do is it looks at options, a scenario. I see we've got a comment about, this is the reason why we trade options. You can have a stop level, you could have a put with a particular strike price. If the market goes lower than it, your put is now going to be increasing in value to offset the losses on your directional play.
Mm-hmm.
So your delta is in the change in your account value is zero, in theory, if you build it properly. But then if the market then goes back in your favor, the put's going to go back to zero and you're still in that position. So there's an interesting thing to do there. But what it will do, what Tasty will allow you to do is it allows you to build that trade, and then it gives you a probability of profit. And it gives you a chance, a mathematical chance on this trade is a 70% likely, it's 70% likely that it's going to hit it.
Mm-hmm.
Now you might make less, but you've got a high probability trade. And that's the whole kind of mantra. And I think once you start to think about things as odds, I think once you start to think about things as calculated risks, the rest of it just clicks into gear. That we're all just little kind of we're all just swimming around in this sea, all trying to make a little bit of money for ourselves. And you're right, Jugger, as you just mentioned on the comment, no loss is as cheap as the first loss. You're completely right with that one.
Mm.
Yeah, definitely agree. And Paul Tudor Jones, who actually have some on my notes here, he never risked more than 1% of his trading. Never risked 1% of his to preserve his capital, and his hedge fund has returned over 200% over the time period it's operating. I mean, that's brilliant, 200%.
Well, Trade of the Week did, I think, 36% last year.
Yeah.
Risking 1% per position, no more than 3%.
Yeah.
And it's amazing. There's an article on the website when you look at the Trade of the Week section, and Axel does the Talking Technically slot on TV now, IGTV. Trade Live with IG. Set in my old ways, Trade Live with IG. And it's amazing the payout chart. If you were to look at your own trade analysis on the website, on the platform, I imagine most people will see big green bars and big red bars.
Mm-hmm.
So sometimes when you've realized big profits, but also unfortunately times you've realized big losses. The Trade Live with IG payout chart is fascinating because there's big green bars and lots of very fixed size red bars. And you know that mathematically it's the losses will be taken care of in the profits because that's just how it's set up.
And he's running a ratio, say 1-3. So he's losing 1, getting 3 if it goes right.
Yeah.
And so the ones that are going right are massively overpaying for the ones that have gone wrong, right?
Yeah.
And it's interesting with the Trade of the Week stuff, because when I looked at it, I thought, these stops are pretty wide in my mind. But actually, with the markets that they're trading, the moves do occur in those sorts of sizes over a week or 2 weeks.
Yeah.
Whereas I think we all get a little bit tunnel vision and we go, okay, well, that seems like a massive stop. Like you need a much tighter than that, and you can do a much bigger size.
Yeah.
And therefore you can potentially make a lot more, but you get stopped out.
You
get stopped out and lose the money, right? So I think that 1%, just to sort of clarify, I think it's not 1% movement in the product. It's 1% of your capital,
correct,
that you are allocating if it gets stopped out. So then you work out how much you want to do and where your stop needs to be.
Yeah. Well, we're going to talk about position sizing in a fortnight's time. I think that's that topic and actually physically how we set stops. What do you keep an eye on to set stops? I think those two are the biggest topics that we're going to take down next. And we may even get Axel, or we may even get someone in to kind of help us with that conversation. I want to just take one of the questions because I think we've covered a lot of these as we go. Say I owned a share and it's gone down 6% in the last 3 months. Should you have moved on to something else? For me, it's the stock price moving 6% is not in your control, but did you take the loss? And is this one 6% loss, or is this, multiple 1% losses?
Yeah.
Right. It doesn't actually, in theory, it doesn't matter what the underlying is and what it does if you're in control of your own position sizing and your own risk management. A stock moving 6% is a bit of a kick in the nuts if you're still in it, but you can't be.
I guess it's the age-old thing. Just to answer there, Monkey Man's question, it's like, is there an opportunity cost? What could you have done with the money? What else could you have done that would have maybe generated you money or not made you potentially be down money? And also, is the instrument that you're holding paying you anything? Are you getting a dividend? Is there a yield? If you're holding a 6 or 7 or 8% dividend yield in stock and you're down 6, well, you net up too. So it's not so bad, right? And also, it all comes down to not just necessarily the percentage movement on the stock, but do you still believe in the stock? Is the original thesis for going into it still alive, and you're right and the market's still wrong, in which case you got to hold it, right? You got to hold it and be proven that you were right because you still believe in it. But the minute you stop believing in the trade and you go, oh, I can't take that because it's a loss. Well, if it's unloved and even you don't like it anymore, just cut it.
Yeah.
Just cut it and move on. You don't have to stay married to every single trade out there. You don't have to win on every single trade that you put on. Your trade analytics doesn't have to just show endless green whilst you've got like a horrendous sort of cancerous loss in your account.
Yeah.
Like it's for, you've got to be a realist when you're trading. You've got to go, you can't have this ostrich technique where you go, right, I'll bury my head in the sands, but look at this P&L that I banked. You go, well, no, actually, look at your overall equity on your account. What is your account worth right now if you hit the button and close it all? And if it's nowhere near what you are sort of showing on your trading analytics, you're living in a false
this is the only
false life, right? You can't hide anywhere.
Cash is definitely not
so it's cold, hard facts to face sometimes, but you go, right, you need to take some ownership of this. And
absolutely. But if you start looking at opportunity costs, if you think, all right, I've lost 6% on this, what could I have done instead? Isn't that an easy way to set yourself up for FOMO? Like you sort of look, oh, I could have done this, I could have done that. And then you sort of all of a sudden jump into these trades that you shouldn't have done in the first place.
But this is where it becomes part of your portfolio, right? You'd argue that discussion is exactly what they call the equity risk premium.
Yeah.
Right? If you know the risk-free rate of return at the moment in the UK is 4.25, I think in the States it's 4.5 still.
Yeah.
If you're looking at the S&P and it returns you 10%, are you realistically going to take on the amount of risk to make the difference, which at 4.5% is only 5.5% per year? Are you going to bother going through the heartache in order to only achieve 5.5% above the risk-free rate?
Yeah.
Maybe not. Maybe allocate a third of your portfolio towards the risk-free rate if it's not for you. But 5% risk, this is the problem. This is why the markets have been selling off, have historically sold off when the interest rates go up. It's because the risk premium on top of that risk-free rate, it starts to break down a little bit. But, I think if you've got part of your portfolio which is performing in line with the market, is your long-term view. Trading shouldn't be a long-term view. It should be get in, make a slice, get out.
Well, I mean, this is what we try and always say, isn't it, to our sort of client base? I mean, obviously it's up to them how much they want to allocate to trading on the high-risk products, such as, the CFDs and the spread bet side of things. But we, typically you want to kind of put a gauge around like 5 to 20% of your overall investment pot
of your own net wealth,
realistically. And you want a big chunk of it in some other stuff. You want it in some safer stuff. You want it in that risk-free return ISAs and premium bonds and all that good stuff, right? But then you come to this area of finance with the piece that you have trying to make, a 4.5% over a year in an ISA. Yeah, that's nice. But on this stuff here, you're looking at, 4.5% weekly, monthly, or intraday. The opportunity is there with the leverage. So you go, right, I could get these pretty monumental gains with a portion of my wealth in a tax-free environment, but how do I protect it? And the answer comes back to where we started, which is have a percentage risk that you're willing to lose on each of your trades.
Yeah.
And then you are entering something which could give you magnified gains, but you've got risk management in place. And if you just come to it and go, well, I've got 100 grand and I'm happy to put 20 in here and, I'll just twist it up 200 times and YOLO, I might make $1 million. You're not going to make $1 million.
Yeah.
Okay. But, if you come with 20 grand and you have a system and you have risk management and discipline, then over the course of a year, you could do something like that trade of the week return where you're getting 30, 35, 40%
and that's
in a tax-free environment, right?
That's incredible.
And you go, okay, I've had a great year.
You don't have
a 20 grand ticket, I've taken, 4, 5, 6 grand tax-free, that's paid for, the holiday.
Yeah, I know. You need longevity.
That is fine. You don't need to come and make £1 million, right?
Imagine trying to.
Everyone wants to.
Imagine trying to start any other job, and you go, right, well, I'm going to be an expert this overnight.
Yeah.
It takes time to work your way through and get promotions and work your way through different departments. Before you're in a controlling situation, before you start your own business and stuff. And it's approaching it in that way. So look, I want to round off the discussion. I think it's really important that we revisit the questions properly about position sizing and stops. There's 2 episodes that I'm going to come back to you, so you got my commitment there. But to round up what we've been talking about. Discipline is easy to say, but it's really hard to do. Having risk parameters is the most important thing, if you can take anything from this conversation, percentage of your account risk, stops and limits, sizing of how many positions you run at the same time, those types of things, they seem boring, but they're so key. So risk parameters, having an exit strategy. I've seen so many people over egg how important it is that they're looking at this particular MACD, RSI on the way in and couldn't give less of a toss how they get out. That is just as important, if not more.
Think about all the people that made money in Coinbase, MicroStrategy, Bitcoin, all on that move post-Trump. Yeah. And how many thought, oh, it's still going higher. And it might be, right? But if you're getting gains like that, you've got to be taking something off the table.
Yeah.
You've done a lot of work to get to that P&L, to see that blue on the screen.
Exactly.
Let's put something in the account. Let's
the
take
good times don't last forever.
Yeah, exactly right. But you say there on the discipline thing, you can do things to make your life easier so that weight on the discipline isn't as much, so that if you do the 1% and you do use a stop, then you make that part of your ingrained process, almost like the sort of atomic habits type thing, where you just embed it as a habit. You go, right, I'm doing a trade, and when I do a trade, I have this 1%, and then you just know, right, my stop's there, and that's it. And then you don't have to worry about that discipline because you've got it in on the trade. It's on. But
it's been done for you.
Yeah.
You are disciplined by having that. Away from the numbers, your question, do the declared 30% of people who are trading profitably with IG follow disciplined trade plans? Yes. You can't get away from the fact that yes.
The most successful traders that we talk to are almost like robots when it comes to P&L. They are dispassionate about the numbers. See, you had a great week. Yeah. I know that I could have a terrible week next week, but I've got a plan and I stick to it to go, okay, yeah, fine.
I'd also be really wary about the people that want to talk about their wins all the time.
Yeah.
The amount of people we've met over the years.
Anyone that saw weddings, no funerals, you got to go, there's something lurking here.
But the amount of people that we speak to that talk a really good game, and that you look at, we look at their accounts, and unfortunately they're not profitable, and you just think these two things don't add up, and the ego gets in the way, and that's where both that piece we talk about bias and psychology. But look, guys, we're running over time. Thank you so much for listening to us. If you've listened to us live, welcome to the world of Talking Shop. If you're listening to us on the podcast, it's great to have you guys back. Definitely watch Trade Live with IG. We do this every morning from 7:30. We are back in a fortnight, and I think we're either going to talk about position sizing or we're going to talk about stops. They both deserve their own episodes. So, gents, we're not going to get a margin call this week because we've run out of time. Maybe it's not appropriate for live, just in case we need to edit things out. So we're going to come back. We do a piece on the margin call where we pick the biggest loser in the market this week. We're not going to do that this week.
It'll be Rich's tucked in t-shirt, I think.
You get the behind the scenes here. He's gone full Jordan Belfort, jeans up here, Nike Cortezes. He's all over the place today. Guys, thank you very much. We'll speak to you in a few weeks' time.